Welcome to the Financial Armor Show. My name is Brad Cooper, president of Cooper Financial Investments. And as always, I want to welcome my co-host, Tony Shore. Hello, Tony. How are you doing today, sir?
I'm just one of these times, Brad. I'm waiting for you to go. I'm Brad Cooper, and my co-host is Brad Pitt.
Well, I can do that.
I'm Brad Pitt. People may not recognize me, Brad, because I've really let myself go. So,
well, if you're Brad Pitt, I'm Bradley Cooper. So we're two
right.
famous.
There you go. That's
guys.
right. That's right. That's right. Well, great to be here. Thanks for having me on your show.
Well, good. How was your past weekend?
Oh, it was good. Last weekend was the Super Bowl.
Yes.
And we were talking a little bit about this before the show. And this isn't a sports show. We're going to dig into the important financial topics of the day. But I do have to say, I was a bit disappointed that the Chiefs didn't show up. Not that I didn't have a horse in this race. You know me. I'm from Minnesota, so I'm a Vikings fan. But I'll tell you what. I could not believe the outcome of the game. I mean, it was basically over with by halftime. I mean,
I know it's sad. You and I think millions of other people were shocked and surprised. Me being from Missouri originally, I was rooting for the Kansas City Chiefs.
Of course.
But you know what? Philadelphia deserved to win. They played excellent.
Oh my goodness.
You know what impressed me even more after the game? Just the sportsmanship and just the character of the coach and some of the players, which I was very impressed.
Yeah, I mean, Philly has a bad reputation for being brutal. I think it's more their fans that give them the bad reputation than the players. However, with Saquon Barkley and Hurts and all the coach, I thought they did very well. And as far as handling themselves and sportsmanlike. I thought their defense, obviously the kudos to the Eagles defense who won the whole game. I mean, they just destroyed the Chiefs. And, I was kind of thinking a three-peat might be nice. I know you're a KC fan. And of course, you and I, we have a lot of friends who work with Gradient Investments and they have people in Kansas. So I was really, hoping for at least a close game, but it was not at all close.
Well, if they would have focused, that is, Kansas City, more on the details, they may have done better. And that's the topic of our show today, Tony.
Look at you with that segue. I think that deserves
yes.
Ladies and gentlemen, Brad Cooper's segue. That was great.
Well, retirement is about the details. And I love the topic we're going to talk about today, Tony, because this is exactly what we talk about in every visit, every meeting with prospects, with clients. It is about the details.
Yeah.
And what we do is very serious, and what details you should pay attention to should be, taken very serious. So let's start off. I have a whole list of things for all the listeners just to take notes and check and double check and triple check. Number one, review the FDIC insurance coverage on your bank accounts. I often hear, and I've heard really all my career and all my life, well, Brad, I have money at the bank because it's guaranteed. Well, that's true. FDIC insurance protects you up to $250,000 per individual account, $500,000 for a joint account. Now, keep in mind, that's FDIC insurance, and I don't want to digress here, but you definitely want to keep less than that in the bank. And yes, it is protected. You would get your money back, but I would encourage you, if you're a strong believer in keeping all your money at the bank, do some research on FDIC insurance and see how long it will take maybe to pay those claims if a bank does go under. I'm not saying banks are bad. I have money in the bank as well, but check your limits to make sure you are protected. I can't hear you, Tony.
Yeah, and sometimes, Brad, the limits are the same in other. If your money is in other vehicles, it's protected about the same, just in a different way. It's not guaranteed by the federal government, which banks are up to a point. And so you do want to look at the amounts you have in banks. And, we don't really talk about money in banks all that often on the show. So that was a surprise that you brought that one up right away. But you're right. I mean, the limit for an individual account is $250,000. So if you happen to have more than that in a bank, that's going to be tough. So you might want to change that. So,
right. I just had a phone call the other day, about a week ago, I guess it was, Tony, and they wanted me to visit with their mother. Their mother had $7 million in her checking account at the bank.
Wait. In a checking account,
In a
7
checking
million.
account. Yes.
I mean, kind of a bad problem to have, but
it's good that she has that much money. It's bad that it's all in one place.
Yeah, they always say don't put all your eggs in one basket, and that's a lot of eggs, even at today's prices.
Absolutely, and you're right. It's don't put all your eggs in one basket. We always talk about diversification. Yes, It is good to have an emergency fund in a bank account, checking, savings, preferably something that's maybe paying today's rates 3 to 4% in a high yield account. So that's money that you can access and get to easily. So that's not bad, but double check those limits. But here's another thing on the list, Tony, that we talked about a couple of weeks ago with our estate planning attorney partner, CJ, but so important. I'm going to be speaking to a group, actually 2 or 3 groups this coming week, and we're going to be talking about this topic, and that's double check, triple check your beneficiary designations on every account that you have. And that, whether it's bank accounts, life insurance, 401ks, brokerage accounts, your home, making sure that's titled properly, whether it's titled to a trust or maybe a beneficiary deed. But double check, because here's the consequences. If you don't have the proper beneficiary designations and you die, it doesn't matter what anybody else says, what other wishes you may have had, whatever is listed as that beneficiary, that's where the money's going to go. In a lot of cases, we hear the horror stories daily about ex-spouses getting the money because a simple change was not made. One of the things that we do at Cooper Financial, and I'm very proud we do a very good job about this, is we do what's called a beneficiary audit. And a beneficiary audit is just always double, triple, quadruple checking, your beneficiary designations, because things change. Life changes. You buy, you sell. So very important to make sure that your beneficiaries are listed properly, and they're so easy to change if they're not.
And review your beneficiaries at least on a yearly basis, because life happens, life changes, as you say. Okay, that's a good one. What else about retirement do we need to know?
If you're still working, which, Tony, you and I are still working, and if you call this work.
Yeah, well, this particular moment, I don't count this as work. This is fun. Yeah.
But if you're still working, still have a 401k, you want to review those allocations that you're investing in on a monthly, yearly basis. This is something that's so much neglected when I'm talking to people who are still working. They don't look at their 401ks. They don't make changes as the economy changes. And a lot of times they're taking way too much risk, and sometimes they're being too conservative. So make sure you review at least annually, if not more often, your allocations. And it's so easy with most companies and most investment firms that offer 401ks that you can go online and you can do that yourself.
Yeah. Yeah. And that's just one more thing. And you're right. The problems can be in the details, some of the smaller details. And these are things that people might miss that we're discussing today.
Right. Another item on the list, we, have talked about this in the past, but I was just reminded about a week ago, I was sitting down with a gentleman, and what we're going to talk about is review the provisions or distribution plan that you have in your estate plan. What do I mean by that? Well, this man came in my office about a week and a half ago, 80 years old, and he hasn't updated his trust in 5 years. So you would think not that big of a deal. What's happened in the last 5 years? In his case, His spouse is in a nursing home with
That's a big
dementia.
difference. Yep.
He's got 2 children. One has cancer and the other one is
Oh.
special needs.
Oh.
So as we were going through with the help of our attorney friend, CJ Eager with Copper Canyon, we realized not only these items were a problem, but also one of the beneficiaries he had listed in the trust was a brother who passed away 3 years ago.
Wow.
So what's very simple about, making changes after reviewing your provisions and your distribution phase and plan of a estate plan, easy to change. But that's something I would encourage everyone at least once every 2 or 3 years, at the very least, just double check. Or if you're like most, Brad, I got a trust 10 years ago. It's about this thick. It weighs about 15 pounds. I shelved it next to some other good books in my Bible, which I haven't read in years, and it's collecting dust. So get that out. If there's any changes that need to be made, a lot of times it's just a simple amendment or, something simple where you don't have to redo the entire trust, if you will.
Right. Yeah, and it is good to review those regularly. Again, probably once a year or once every couple of years at the least, to make sure you're updating things. And I know you have regular reviews with your clients, and you bring in CJ if they need estate planning help. I think that's fantastic. That's really, really important. And make sure you don't leave your loved ones or your children in a bad way. Make sure that goes back to the beneficiary designations we talked about. That's so important.
That's, what it does for me personally. It just helps me sleep better at night. And I'm just so proud. I'm going to, speak kudos of my oldest daughter. Just this morning, she went in and had her trust updated because she just married about a year ago. And she just realized she's expecting her first child. So I'm going to be a grandfather, which I'm pretty excited about. So a lot has changed in the last 12 months for her. So she had an appointment, updated her existing trust. So proud of her. I didn't even have to tell her to do that.
Yeah. I thought you were at least 20 years away from being a grandparent. You don't look old enough to have grandkids, that's for sure.
The power of editing and cameras, right, Tony?
Right. Actually, it works reverse for me. I always joke the camera adds 100 pounds. You know that.
I've always been told that, so I wish that was the case. Off camera, I would look 100 pounds less.
No, it adds 100. Yeah, yeah. I do. If people meet me in person, it's amazing. Yeah, this is all just the camera. But okay, so review your FDIC insurance coverage. How much do you have in the banks? Where are your assets allocated? Review your beneficiary designations. Don't let your 401k go. You got to review to see if changes need to be made to that. You need to review that at least once a year. And then you talked about provisions for your children. Make sure that your wills and your trusts are all up to date. That's huge. So if our listeners have questions about anything we've talked about so far, or they want to set up that no charge, no obligation consultation, how do they get a hold of you, Brad?
So easy, Tony. If you have a question and just want a simple answer, you can go to our website, financialarmorshow.com, and type in your question, and we'll respond back very quickly. Or if you want to do it the old-fashioned way, which we prefer, pick up the phone, call 888-390-5277. Again, that's 888-390-5277. We enjoy our team at Cooper Financial answering questions. I just had the privilege last week of having a nice conversation with a listener in Texas, which was pretty exciting. And he had some great questions, and we just gave him more clarification of what he was doing and confirmed what he was doing was right. So
excellent. Well, and I know it's so important to have an actual written plan in place. I encourage our listeners and viewers to pick up the phone, give you a call, set up that consultation, and to make sure your finances are properly allocated and your retirement plan is in place. So really, retirement, a successful retirement is all about the details. I think that should be the name of the show. A successful retirement is about the details, right? So what are some more details people may forget about when it comes to planning for a successful retirement?
Here's a topic that we have a conversation with on a daily basis with our clients and new people that come in is how can you maximize the amount you're earning on your cash? Now, keep in mind, there's a lot of people in our industry that would not give this advice that we give. They'd say, let's just take it all, let's invest it. The chance of you earning more is much greater in the stock market. And I would agree with that. But, what's the purpose of the money? What's your goals of your money? So, one topic that we talk a lot about, and again, we're not in the banking business, but, look at your current bank account, your credit union account, your savings account, checking account, and see what percentage your institution is offering you. I can tell you, Tony, over the last couple of years, when I started doing this more seriously, I took the time on a weekend. I realized, not to mention any banks, a very large bank who I bank with was paying me zero. And I found a bank, which is, probably one of the top 10 banks, not to mention any names. There's many of them. Back 2 years ago was paying me 5%.
Wow.
They just lowered it to 4%, a high yield,
a huge difference.
Savings account. Yes. So, and that's money. And when we talk about these types of accounts that you're keeping at the bank, these are liquid accounts. These are accounts that you can get access to your money very quickly with no fees. Right. And you also have the guarantee of the FDIC insurance with that. So shop around and keep your eye on what other institutions are paying. And if you need to make the move, it's very simple in this, age of technology where almost everything's online banking.
Yeah, true. And you can shop around for banks. That's a good idea. A lot of people, at least, especially in our generation and older, they're not used to that. They're used to working with the same bank, same people. And once you start working with them, you stick with it. Nowadays, my son is like on his third bank because he goes, they offer better. I'm switching over here. It's like,
right.
Okay.
When we were growing up, and I know our parent generation, Tony, it was all about loyalty. And I still hear that from clients today.
Yeah.
I have banked with them for 40 years, or, I've had the same insurance company for 55 years and they just dropped me. Well, let me just be blunt. There's no loyalty today with any company, big company. You're just a number.
Right.
And you should shop around, not only with banks, but insurance companies too. That's a different topic. We're going to have one of our insurance specialists on here in the weeks to come that can talk more about that.
Yeah.
But speaking of banks, another area that we're bringing up is, again, we're not in the banking business. We're not in the mortgage business, but we're finding out what interest rate and what type of loan that you have on your current house. If you have an adjustable or maybe a high fixed rate loan, it may make sense, depending on where rates are, to refinance.
Right. Yeah, adjustable rate loans can be tough. One time, my wife and I, when we didn't know what we were doing, we got an adjustable rate loan. And we thought, this is great. This is great. Low payments. They said our payments only be, and then it just skyrocketed. And here we're stuck in this adjustable rate loan and paying super high interest, and the payments went way up. And I'm like, wow. And we should have locked in at a median rate, and we would have been better off, if you do the math. So you want to make sure that you're doing the right thing. And again, I know that this is something you can help your clients with. If they come in, you just look at the math and say, okay, you might want to do this. And you work with mortgage experts and people in the real estate industry that can help them. So I think that's great as well.
It's true. And something else that we have been recommending almost to every client of ours the last, year or so, and I think I may have mentioned this before, but I think it's important to mention this again. a lot of our clients who are retired that maybe have a house that's paid off, or they have a lot of equity in the house, and they have the majority of their money in pre-taxed accounts. What are pre-taxed accounts? IRAs, 401ks. We're recommending them to go to their bank, go to their credit union, and open up a home equity line of credit. A HELOC is another fancy name for that. And it's interesting when I'm recommending this. Well, Brad, why would I want to have a second, lien or a HELOC, home equity line of credit, on my house? Well, two different reasons of many I want to cover. Number one, let's say there's an emergency. You need to get your hands on $100,000. Within seconds of transferring the money from the HELOC to your bank account, you could have that money. And by the way, that's tax-free, which leads to another reason why, let's say the majority of your money is tied up in IRAs, which is all taxable, which that's a lot of Americans today. If you need to get access to $50,000, $100,000, a lot of times if you pull that big of an amount out of your IRA, that could cause you, in some cases, to jump up to a higher tax bracket, also impact your Medicare premiums, and IRMA, which is a surplus on top of your Part B, would increase per month for the next 12 months. So it's just nice to have that as a emergency backup. And I practice what I preach, Tony. I have one, my wife and I do, on our house. And the way it works is if we use it, we just have to pay the interest on the outstanding lien. But if we never use it, it's just sitting there. Once it's set up, there's no cost.
Yeah. We got a HELOC to do some home improvements, and it's great. You don't ever want to pull that money out of a retirement account because you're going to lose out on all the compounding interest. You're going to have to pay taxes on it, because all those tax-deferred retirement accounts, which are most retirement accounts, unless you have a Roth, that money does not come out tax-free. You pay taxes, and you pay penalties if you're not older than 59 and a half, right?
So true. So true.
Yeah.
Another thing that was on the list, which is often overlooked, if you will, is track your HSA funds. So, Tony, what's an HSA?
A health savings account.
Right. This is money. I know. I just actually this past weekend, it's funny. I was looking. I was on my HSA site, and I was getting ready to contribute for 2025, and the maximum, I believe, is $9,550 if you're over the age of 50 to contribute. What's great about that is there's tax benefits. The earnings are tax-free as long as you use that money for medical bills, healthcare expenses.
Yeah. And you can use it for a lot. I mean, you can use it for aspirin or things you might buy. You can use it for, it doesn't have to be hospital bills or doctor bills. There are other healthcare related expenses you can use an HSA for, which is great.
Right. So that's another thing that's overlooked, but also consider life insurance. We've talked in the past about life insurance, and, life insurance can serve many purposes. We're using it not necessarily for a large death benefit, even though we are with some of our clients that want to leave a large legacy, but also it's a great tax planning tool that you can put money in that will grow tax-free. And then a lot of these newer life insurance policies have long-term care benefits built in where they will pay if you have an in-home healthcare need, a long-term care need, assisted living. So consider that. And what I've seen, Tony, especially more so in the last probably 10 years, when they really increased the benefits to some of the life insurance accounts that we recommend, what's sad is our industry as a whole, especially the investment world, they don't often recommend life insurance. I'll tell you why. It's complicated for them, and it's not as profitable. And a lot of times the brokers will not allow their investment advisors to even talk about life insurance.
Right, because they want all your money in the market because that's where they make the money.
Absolutely.
But as an independent financial advisor, you look at everything. You have investments for your clients in the stock market. If they're younger, maybe it is all over there. But as they get older, you might say, hey, you should have this life insurance, or you could utilize cash value life insurance, or a hybrid policy you've talked about long-term care. That can help cover, and you can look at all the companies, right? Be competitive.
That's right. That's what's wonderful, Tony, about being independent, being a fiduciary. And as a fiduciary, we take that very serious. We have to always look at what's in your best interest, not ours. And unless you're working with a holistic fiduciary financial planner that can deal with not only investments, but insurance, taxes, long-term care, estate planning, elder care planning, income planning, social security planning, and the list goes on. There's many pieces of what I like to call the financial puzzle that if you're missing those pieces, that could be a detriment to your long-term retirement plan. And here's one thing I'm just reminded of daily, Tony. People just don't know what they don't know.
Right.
And that's where we do a very well job. Our team does, as far as, just sitting down and educating and informing you of what I call common sense money principles that the rest of our industry should be doing a better job, but unfortunately not.
Yeah. Well, I think that's a great point and a good note to end the show on. We've covered a lot of the details, and retirement is all about the details, especially a successful retirement plan. And Brad, there are many. So if our listeners have questions or want to get a plan in place, whether it's about estate planning, whether it's about asset allocation, investments, retirement income planning, how do they get a hold of you?
Absolutely. And this is, for all of our listeners and also for the Kansas City Chiefs players, if you want to know the details of winning your retirement plan, go to financialarmorshow.com. A lot of great resources. Ask the questions you may have, or call our office. We'd be more than happy to sit down with you for a free consultation over a cup of coffee. You can call our office at 888-390-5277, and we'd be more than happy to visit with you.
All right. Well, that sounds great, Brad. Good show today. Viewers and listeners, thanks for tuning in. We appreciate you. I know Brad loves to hear from you. And that does it for today's episode of the Financial Armor Show with our host, Brad Cooper.
Thank you, Tony.